Apple is down 11% year to date, with some analysts giving a strong buy rating with a price target of $250. In today's episode, we're going to do a deep dive into this company. We can see analysts calling it for around 31% upside, and that is on the lower end of the future price projection. They also did recently buy a Canadian startup, Darwin AI, which we're going to take a little look at in today's episode. We'll also update ourselves on their revenue, how it is faring over the last few years, as well as their bottom line net income. We'll have a quick refresher on the health of the company, their cash versus their total debt, and we'll see how they're performing versus others in the Mag 7 with some more recent movements in the market just over the last week. We'll discuss some insider selling that we have noted just a few weeks ago from one of the directors of around $18 million. And we'll see if institutions are still buying this company after the drop we have seen this year. And as always, we'll refresh ourselves on the dividend safety. We'll look at their financial metrics, their free cash flow, and we have a few other bits of information we want to take a look at today, including the Vision Pro. We want to see what the forecasted units are saying versus actuals. And also we're going to discuss about a cheaper Vision Pro, which is expected to be released not too soon, and a few other bits of information that we do want to bring in today's episode. As always, we'll also run them through the valuation model, getting to our intrinsic value based on our margin of safety, and get that acceptable buy price whilst looking at Wall Street's forecast for the next 12 months. Now, taking a look at those price targets, as we can see from this article, the Bank of America analysts have renewed their price target on Apple, giving it a $225 target. That represents around a 31% increase over the next 12 months. As I mentioned though, we will do a little bit more look at Wall Street and their forecast. However, this is just one, and as we have discussed, we have seen others of around $250. Now, over the last 12 months, Apple is still up around 12%. We can see that on the 52-week range, it is towards the mid to lower end. It does offer a yield, so 0.55% forward looking, a forward PE sitting just over 26, and a market cap of 2.67 trillion. Now, if you've been a long time holder of around at least 10 years, you would be up around 799%. Bear in mind, this doesn't include those dividends reinvested. As we mentioned, they have recently bought a Canadian startup, Darwin AI, and on top of that, we can see that they have also brought across their staff. As we can see, they have added dozens of the Canadian company staffers to their AI division. So I don't know if you did heard, but they did essentially stop what they were looking at in terms of their EVs, spending a lot of money, around a few billion. They are now looking at bringing in this artificial intelligence into more of their products and really driving that home. Because when we take a look at their top line revenue, yes, over the last 5 years, strong growth from 260 billion to 383. But what we do know, over the last 3 years, that growth has not only slowed down, going from 366 to 394 in 2022, but it has also dropped, as we can see in 2022 to 2023, reducing to 383 billion. So yes, over the longer term, we do see Apple's top line increasing, but in the more recent period, it isn't looking too great, and they do now need to find ways to really start kick growing that top line revenue. In terms of their bottom line, well, that is a little bit better. 55 billion in 2019, 97 billion in their latest annual report. We do see increases all the way up to 2022, and then a small drop into 2023. So a little bit of a similar story. Yes, both top line and bottom line are increasing very rapidly in the right ways, but now over the more recent year, we are seeing a slowdown, and that is something that Apple are starting to figure out. Taking a look at the health of the company, well, quick total cash versus total debt. We note their cash has dropped from around 100 billion to 73 billion from their latest quarterly report. Still a very significant amount of cash sitting on their balance sheet. And in terms of their total debt, well, it has pretty much not moved from around 108 billion to exactly pretty much the same here, 108. So their cash has reduced quite significantly, around 30%, whilst their total debt hasn't really moved. And we'll look at the net debt to EBITDA metric, but in reality, no real worries with their balance sheet so far. Looking at the Mag 7, we have Tesla, Nvidia, Alphabet, and the others. Well, what we can see over the last 12 months, Apple is the second worst performing, up 12.7%. Not the greatest when you look at the S&P, which was actually up a lot more over the last 12 months. We do see just better than Tesla, which is in fact negative 12%. When we extend that over the last 5 years, we see Apple as one of the mid-performing, up 282%, which is a very strong performance over a 5-year period. But as I always say, do bear in mind, past performance is never an indicator of future performance. Now, just something to bring to your attention, just a few weeks ago, we did see a major sell by Arthur Levinson, the director. He sold 100,000 shares at a price of $181 for a total of $18 million. And we can see since then the share price has come down negative 6%. In all honesty, this isn't really any signal in terms of bearish, as they sell for many reasons. That is insiders, but we're just bringing transparent. Just want to show you no buys. However, we do note a very large sell. Institutional ownership is 58.51%. No real surprises. We do see selling of those institutions of 75 billion, but essentially nearly double of inflows buys over the same time period. So we can see, not in fact just over the last 12 months, but in the more recent quarter, Q4, a lot more buying by the institutions. Q3, more selling. Q2 and Q1, we see more buying. So overall, institutions are loving this company. We can see in the more recent quarter, with the share price dipping, they have been looking to add more shares to their portfolio. You can bear that in mind in your investment thesis, but never solely rely on it, and always do your own due diligence. Now, something we just wanted to point out in terms of the Apple Vision Pro, the performance. Now, the forecasted units was around 460,000 upon release. What we can say now is that they're expecting these to have increased to 600,000 units in 2024. So quite an increase. Do bear in mind the price is very high, $3,499. It isn't like the typical products that Apple sells that is there for the wider market, like the iPhones for $1,000 or the Macs, which are slightly more. This is significantly higher at $3,499. Now, on top of that, we can see that this analyst has increased their target price for Apple. They do expect this to hit around $250 with an outperform rating. So again, as I mentioned, a lot of people are expecting Apple's share price to increase substantially over the next 12 months. And what we also note here is that a cheaper version of the Apple Vision Pro is not expected into 2026. Something just to bear in mind in terms of when we look at their numbers on the top line. And what it is expected is that they will be coming out with around a $2,000 version in this time period, and they expect an incredible 4 million units to be sold. Again, this is a bit of speculation, but something just to bear in mind when we are thinking about how they can increase their top line, whether or not Apple Vision Pro will save the day and increase their top line in a very strong way that we haven't seen over the last few years with this company. And this shows it right now. We can see over the last, in fact, from 2000 to 2023, the number of products that Apple have brought out, the different type of products. We have the iPod 2001, the iPhone, the iPad. And in fact, their more recent product was the M1 Mac in around 2020. Since then, nothing really other than the Vision Pro, which a lot of people do argue it is a very expensive piece of equipment that isn't necessarily obtainable for the average person who does buy Apple products, as we mentioned, like these products we can see on screen. However, their forecasted revenue is expected to be a nice increase over the longer term, around 10% on a compounded annual growth rate, and in terms of their EPS, around 10 to 11% over the same period. So something to bear in mind as when we do take a look at that valuation on the DCF model, that will come in handy. And just to let you know, we have released our latest free weekly article. If you want to gain access to this, as well as our other articles, all completely free, do click on that pinned comment below. So looking at the metrics, well, no surprises. Dividend safety, 99, very safe. The yield is very small, so there are no expectations for it to be anything lower than that. Market cap, 2.7 trillion, a mega cap company. When we look at the key metrics, well, no dividend was paid in the last recession. The recession sales, very strong, plus 14% versus the S&P's negative 12. They had a near S&P return, negative 50 versus the S&P's negative 55. And in terms of dividend growth, I would call this pretty poor from Apple. Yes, it is around that minimum we expect just to keep up in line with inflation of 4%. But realistically, over the last 5 years and over the last 10 years, we have seen a lot better. And when we do take a look at their payout ratio, it is low enough that they can increase this a lot more. But for whatever reason, they don't seem to be interested in that. They have been increasing those dividends for the last 11 years. And when we take a look at dividend yield theory, we can see here signs of slight reasonable valuation, slight overvaluation. So dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. As we can see, 0.56 versus 0.63, so not exactly that undervaluation signal. Although we do note the forward P now sits lower than the 5-year average, so that is a slight undervaluation signal. Bear in mind though, we don't look at any of these in isolation and will conclude towards the end. Information technology sector P is also higher at 27, with Apple looking very low. Now when we take a look, as we mentioned, at the free cash flow payout, it is significantly lower. In fact, it has been decreasing below 20% over the last 4 years. 2024 at 14%, so I would be really shocked if we don't see a much better dividend increase this year. Free cash flow per share been increasing, in fact, 3 times over the last 10 years and is expected to go even higher into 2024. So that is a positive sign with Apple. Yes, their top line is slowing down, revenue has decreased, but they are finding a way to consistently increase their free cash flow year on year. Sales growth then, we want to see steady, moderate growth, really 3 to 7%. What we can see though, we saw that negative 2023 figure of negative 3%. Before then, we do see some nice growth, a little bit inconsistent, but overall, over the longer term, they are finding ways to really increase their top line. And here's hoping that they will find the way with the Vision Pro to bring it to the masses, whether or not it is a cheaper product, around $2,000. I would be interested to know though below if you would buy the Vision Pro if it was around $2,000 for roughly the same capabilities as the current product. So we can see the top line has more than doubled over the last 10 years, and what they also do to return that excess cash to investors, essentially increasing your stake in the pie, are those share buybacks, buying back a significant number of shares from 24.5 billion in 2014 to 15.7 in the more recent period. ROIC very strong, well above the minimum 10% I look for. In fact, 31% in 2014 has only been going up year on year. So that does give us faith that management are able to effectively allocate their capital. And we can see, in fact, operating margin consistently very strong, 30% over the last 3 years. And the same can be said for the free cash flow margin. When we look at the net debt to EBITDA, essentially showing us the number of years it would take the company to pay off all of their debt net of cash on hand, well below the 3 that we want to see as a maximum. 0.44 in 2023, expected to go lower in 2024 at 0.24. So we can see no worries with their balance sheet and realistically no worries with that dividend. So all looking good so far. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so we are continually notified of these videos as they drop. Now the first model we're using, it is going to be the multiples valuation, companies in a similar sector and size. We have their average P multiplied by the EPS of Apple to get an intrinsic value, showing our signal here of undervaluation. Do bear in mind though, we're not looking at any of these models in isolation. Now typically we would use the dividend discount model, however for Apple it doesn't really seem to be appropriate given the yield is very, very small. It doesn't seem to be one that would be accurate to reflect the intrinsic value of this company. So for today's episode we won't be using this. Instead we're going to go straight to the DCF model. We'll discuss 3 different looks at low, medium and high. What we've done is we've got the free cash flow year on year. We've got the average growth rate of around 10%. Forward looking, now we've gone for the lowest rate at 10%. If you want to use higher, we have a medium of 12, a high of 14. Based on this, we get the present value of future free cash flows and terminal value with that discount rate. We then add the cash, subtract total debt, get the equity value, divide by shares outstanding, and we get that intrinsic value based on a 10% rate. And as we can see here, $206. That signals purely on the DCF model 20% upside. If we would change it to 12%, as you can see here, this would be 237, and we have this here. That would be an implied upside of 39%. And if you believe 14%, you can see 273 with upside of 60%. Now we're going to take the 10% growth rate, which we estimate to be the lower end of their growth rate forward looking over the next 10 years and beyond, to the final intrinsic value calculator. So as always, the intrinsic value is just the average of the models that we can see on screen, coming to $205. Don't forget you can grab a copy of this model if you want to get to the intrinsic value of companies in your own portfolio, those in your watch list, or even if you want to run through Apple based on your own estimations, clicking on that pinned comment below. Margin of safety then, we start off with 10%, which we use if we essentially believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. Then we go to 15%, a buy pretty much around the current trading price. It isn't at a 20% margin of safety yet until it reaches around $164. So we believe it has at least a 15% MOS level in the current market. In terms of Wall Street and their expectations, well, on average, they have around a 205 price target for the next 12 months. Some have it higher, as we just ran through Bank of America at 225, and we have other analysts giving it a 250 buy rating. Now, the 205, as we can see, is implied upside of 20%, so even at that lower end, we do see a very strong buy signal. As always, though, do let us know your thoughts in the comments below. Bearing in mind, do you see that they will be able to continue to increase their top line? They did stop their production on the EVs, and also they have now essentially looked to start buying other companies that are into AI, as well as others, giving them maximum exposure to that industry and looking at implementing those in their products, whether it's the iPhones or iMacs or any other ways that they can start to increase their top line. As always, let us know your thoughts below. This is one that I hold currently indirectly through ETFs, but if it does start to come down to that 20% margin of safety, I will start to dollar cost average, as I do believe over the longer term, Apple will still be a very strong brand, giving a lot of wealth through to their shareholders, whether it's through share buybacks, the ongoing dividend increases, as well as share price appreciation. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.